Time for a check of the numbers, and for all you listeners on XM Radio Channel 128, we know you can't see us, so we're going to spell them all out for you. Dow Jones Industrials down 113 points at the moment. NASDAQ also underwater by about 25 points, or a clip of 1%. S&P 500 down 10 2/3.
The Dow is still down 113 points. Quite difficult to invest optimistically, of course, but our next guests are here to help us find opportunity out there, or at least how to search for it.
Dave Stepherson is Vice President at Hardesty Capital, along with Keith Springer, President of Capital Financial Advisory. Good to have you both. Dave, I'm going to throw this one to you. There is a huge difference between short-term investing and long-term investing. For the short term, what do you like right now?
Well, obviously for the short term, you got to go with what's working right now. And the areas that are working right now seem to be technology and, to some extent, healthcare. So that's where you probably want to have money that you're ready to put to work right this minute. And specifically, I would be looking at software stocks. They seem to have the best valuation multiples. And in the healthcare sector, we like the medical devices. And these are all the right now type stocks.
Keith, I want to ask you, because we told our viewers that we're going to tell them where to find opportunity in this marketplace, and I'm going to ask that direct question to you. Where's my best opportunity in the stock market right now?
Well, Stuart, short or long term does make a difference, because we've got to remember we're in a bear market, and in bear markets it reacts more to bad news and goes down, and then, basically ignores good news. And in bear markets, you make lower highs and then again lower lows, so you've got to react pretty quickly. I agree technology is probably the best situation out there right now. It is acting the best in this little pullback. I think it probably offers the best opportunity for the intermediate term. I would definitely favor growth over value. I am starting to look at commodities. I think commodities had a parabolic rise up, and they were way overvalued a few weeks ago. They're getting down to where you probably could buy them again, and they could create very good long-term opportunities. I think oil could go a little lower, but will go much higher a year from now, and same with agriculture.
Keith, let me press you on that about commodities, and you think that maybe the sell-off is done. How can we see that parabolic dramatic rise, in some cases more than 50% over the past year, year and a half, depending on which commodity you're talking about, yet we have a measly 20% cut down in oil at the moment. We're still well above $100 a barrel. How much further do you think that we have to go?
Further down the downside, I think.
Yes,
well,
yes.
I was actually on the show a few weeks ago when oil was about 140, and I was looking for a break of 120. I think it could go below 100, but at that point, I think would be the bottom. Anywhere from 110 to 100, you have probably a good opportunity, and I don't think it's going to spike up from here, but there's definitely a long-term opportunity in oil. The demand has not been squashed long-term. The building that is required in the emerging countries didn't go away just because of a 2 or 3 or 4 month rise in oil. India, China, these emerging markets, they're still going to need steel, and they're going to need oil. And this parabolic rise that we saw a few weeks or a few months ago is not going to be enough to offset it for the long term. It's just pulled it back. We also got to remember we're in the summertime. Traders are on vacation. It's a lot of things are very different in the summer when traders are not available. Oil's probably taking a rest here. I was hoping for it to be for a few more months, because the lower oil prices go, the higher stock prices will go. But I do think a year from now, oil and agricultural commodities are going to be much higher.
Dave, I want to get real specific for a second. I've been reading my notes. I believe you like Amgen and Intel. Make your case, Dave.
That's right. Well, Amgen has been a stock that's been under a great deal of pressure over the last couple of years, specifically because of some bad results on some clinical trials, as well as some FDA pressure on labeling on 2 of their biggest products. But they do have a pipeline that is very robust and starting to show signs of, for the first time in quite a while, some positive news. And the stock is beginning to move in a direction that we think will take it well above 70. And with respect to Intel, we think we've seen the bottom of the semiconductor cycle. We probably saw that in, I guess, the fourth quarter or maybe the first quarter of this year, fourth quarter of last year. And Intel is showing tremendous, we think, for where we are economically in the cycle, tremendous levels of growth. They're winning market share from AMD, from a number of different vendors. So things are very positive, we think, for Intel.
We should mention that we have one of the vice presidents of Intel coming on in the 3 p.m. hour. They are rolling out a brand new chip They really want to take on AMD, so that's definitely an interesting point. Keith, give us your final thought on the overall markets. And as an investor, speak to the investors out there who maybe have a pension or a 401k who are a little worried right now.
Well, the markets definitely are a cause for worry. Longer term, the markets could have a little bit of resistance. We do have a changing demographic in the nation. The baby boomers are getting older. They're turning from net spenders to net savers, which is going to affect it longer term. I do think we have a nice rally in the intermediate term, and right now I think we're in the middle of it. I think stocks can rally up quite a bit. But over the longer term, you've got to be more cautious. As people get older, they need to be more conservative. You've got to pare back the risk, and people aren't used to paring back risk. People are used to taking more risk than they should, and it's important to understand where you go, what sectors to be in, and where you want to go.
Thank you so much to both of you, Dave and Keith. We'll see you once again.
Thanks.
We've been telling you for weeks about how